Okay, so in the notes on this section, Learning Objective 1, Chapter 3, there are all of the terms, basic terminology are written out for you, so I didn't write them out again for you here. What we're looking at here is the accounting information system. It's collecting a lot of data, organizing it, and communicating it to interested parties. So you have to start to think a little bit more theoretically about basic journal entries that you've done since AC 101. And along with a bunch of terms that may seem silly, but they're just part of knowing the language of business, which is accounting. So they talk about an event. An event is something of consequence that triggers a change in the assets, liabilities, or stockholders' equity of a company. And this event can be, it's like an economic event, it can be internal or external. An example of an internal event would be the depreciation expense that's taken. There's no check made out for that. It's simply you have an asset on the books and internally you are depreciating it over its useful life, taking the expense a little each year. The external events are ones that involve other entities, things you write a check for, where you get sales revenue from, things like that. A transaction is an external event. It has a financial effect, but it involves the exchange of something between two or more entities. Okay, account. This is where you put all the information into each account. It's like a storage container, so you have an account for cash, for accounts payable. We are getting into the terminology for different types of accounts now. So we have real accounts and nominal accounts. Your real accounts are your permanent accounts that appear on the balance sheet. These accounts do not get closed, okay? So real, permanent, balance sheet don't get closed. Nominal or temporary accounts are the ones for which we do closing entries. So these would appear on your income statement, also dividends. These are closed at the end of each period, so we'll end up with zero balances at the end of each period. Okay, so you need to know the difference between the general ledger and a subsidiary ledger. The general ledger is the total of all it keeps a list of all your different assets, liabilities, and equities. Your subsidiary ledgers are more detail on specific ledger accounts. Think accounts receivable. You've got 4,000 customers. You've got one amount for accounts receivable in the general ledger, but the subsidiary ledgers would show how much each person owes you, okay? And same for accounts payable. Let's see. Journal, I hope you know it's the book of original entry. Transactions are entered in chronological order. We post from there to the ledgers, do the trial balance. Then at the end of each period we do our adjusting entries, do the adjusted trial balance. I hope this all sounds very familiar to you. And then we prepare all our financial statements. After the financial statements are prepared, then we do the closing process, all the closing entries, and then the last step would be the post-closing trial balance. Working through some of the problems in Chapter 3 will give you a very good review of this. And yeah. Okay, so you have to know debits and credits. If there is any need for you to review any of that, I believe in the orientation section I've got some, like a review of AC 101, which includes in the Chapter 2 section of that all you need to know about debits and credits. The accounting equation, we get into a little bit more detail. You're very familiar with that. But we're going to be thinking more theoretically now. We've got assets, you know, it's what you have, what you owe, what you own. What you own, we want to focus a little bit on here. The paid-in capital, we want to think of that as invested capital. It's capital that's been invested in the company. It doesn't have anything to do with our revenues and expenses. This is capital, you know, our common stock, preferred stock, all of our money that is, or, you know, what has been invested in the company. As opposed to the other section of stockholders' equity, which is your retained earnings. So this relates to the operations of the business. It's the sum of all the revenues minus the expenses since the company started that has not been paid out in dividends. So if you think about retained earnings, your statement, it starts with a beginning balance, you add your net income, which is your revenues minus your expenses, and then you deduct your dividends on that retained earnings statement. So the retained earnings is basically the sort of the total of all your revenues and gains, expenses and losses, less dividends paid since the company began. Okay, but make the distinction between invested capital and this would be more earned capital, okay, that has not been paid out in dividends. Okay, one thing you'll run into in this course that you have not run into before, so far we have done our financial statements for corporations, and this is the format for corporations. When we get to some of the problems, they're going to be doing proprietorships or partnerships. So instead of paid in capital for a partnership, it would be called, let me allow enough room to write this, owner's capital. So you do owner's capital if it were a proprietorship. That would be the equivalent of paid in capital. The dividends would be owner's, wait a minute, that needs an N in it, O-W-N, owner's drawing. And that would be the equivalent of like your dividends account in a corporation. Okay? So investments by owners would be called owner's capital, and with owner's drawing would be dividends. So when the owner takes money out of the company, you do not debit the owner's capital. You would be debiting the owner's drawing. Okay, you will run into that. Okay, so I think that's about it for Learning Objective 1.